Hello students, welcome to today's episode. In the earlier episode, we have discussed the two ratios which were activity ratios and profitability ratios. So in this session, we will be discussing the remaining two ratios, that is liquidity ratios and leverage ratios. In addition to this, we will also discuss dew point analysis. I am Dr. Arshia Hussain, teaching in the Department of Commerce and Business Studies, Jamia Millia Islamia University in New Delhi. So let us start with the liquidity ratios first. The term liquidity refers to the maintenance of cash, bank balance and those assets which are easily convertible into cash in order to meet the liabilities as and when fall due. The liquidity ratios study the short-term solvency of the firm. By short-term solvency, we mean the firm's ability to pay off its current obligations. Liquidity ratios are of the following types. The first one, current ratios. Then second, quick ratios. Third one, absolute liquidity ratios. The fourth one is defense ratios. So we'll first of all, we'll see current ratios. Current ratio shows the relationship between current assets and current liabilities. It is calculated to assess the short-term financial position of the enterprise. Current assets are those assets which are either in the form of cash or cash equivalents in a short period of time, say within a year. Examples of current assets are cash in hand, bank balance, bills receivables, debtors, stock in trade, marketable securities, that too short-term marketable securities, prepaid expenses, short-term loans and advances, that is debit balance. Now, current liabilities are those liabilities which are to be repaid in a short period of time, say within a year. Examples of current liabilities are trade creditors, bills payable, bank overdraft, short-term loans and advances, that is your credit balance, income received in advance, outstanding expenses, provision for taxation and proposed dividend. Now, this ratio is calculated as current ratio is equal to current assets divided by current liabilities. Generally, a current ratio of 2 times or 2:1 is considered to be satisfactory, though this is not applicable to all cases. This standard current ratio may vary from one industry to another, and therefore, a firm's current ratio should be compared with the standard for the specific industry only. The higher the current ratio, the greater is the margin available and the less is the chance of the firm's failure to meet its commitments in time. So, it must be noted that current ratio considers only the quantity of current assets and ignores the quality of current assets. Now, we will have a look at illustration. From the following information, calculate the current ratio. Stock rupees 15,000, bills receivable rupees 5,500, debtors rupees 14,000, bank rupees 9,000, cash rupees 6,000, creditors rupees 16,500, bills payable rupees 7,000, prepaid expenses rupees 500, debentures stands for rupees 25,000, land and buildings rupees 60,000, provision for taxation rupees 1,500. Now, we will have a solution for this. We know that current ratio is equal to current assets divided by current liabilities. So, the summation of all the current assets, which is stock plus bills receivable plus debtors plus bank plus cash plus prepaid expenses, that comes out to be rupees 15,000 plus 5,500 plus 14,000 plus 9,000 plus 6,000 plus 500. So, the total current assets is equal to rupees 50,000. Now, current liabilities. Current liabilities is equal to creditors plus bills payable plus provision for taxation. So, that stands for rupees 16,500 plus 7,000 plus 1,500. So, the total of current liabilities is equal to rupees 25,000. So, thus current ratio is equal to current assets divided by current liabilities, which is rupees 50,000 divided by rupees 25,000. So, that comes out to be 2 divided by 1. Hence, your current ratio is equal to 2:1. We will see one more illustration on this. From the following data, calculate current ratio. Liquid assets is given rupees 36,500. Stock is given to us as rupees 11,500. Prepaid expenses is given to us as rupees 2,000. Working capital is given as rupees 30,000. Now, we will see the solution to this. We know that current assets is equal to liquid assets plus stock plus prepaid expenses, which is equal to rupees 36,500 plus rupees 11,500 plus rupees 2,000, which is equal to rupees 50,000. Now, current liabilities is equal to current assets minus working capital. So, we have rupees 50,000 minus rupees 30,000, that gives us rupees 20,000. Now, current ratio is equal to current assets divided by current liabilities. So, which comes out to be rupees 50,000 divided by rupees 20,000. So, the current ratio is equal to 2.5. Now, we will see another ratio which is known as quick ratio or liquid ratio or asset test ratio. Liquid ratio is also called the asset test ratio. It measures the short-term liquidity of the enterprise in its correct form. It shows the relationship between liquid assets and current liabilities. Quick assets are those assets which can be converted into cash immediately or at a short notice without a loss of value. It includes cash and bank balances, ready marketable securities, debtors and bills receivable, and short-term loans and advances. Inventories and prepaid expenses are not considered as quick assets. Thus, quick assets is calculated as quick assets divided by current liabilities. 1:1 ratio is considered ideal ratio for a concern because it is wise to keep the liquid assets at least to the liquid liabilities at all times. The other type of ratio is absolute liquidity ratio. This ratio is also known as super quick ratio or cash ratio. This ratio considers only the absolute liquidity available with the firm. Cash and bank balance and marketable securities are the examples of highly liquid assets. Thus, absolute liquidity ratio is equal to cash plus bank plus marketable securities divided by total current liabilities. Now, we will see one illustration on this. You are given with the following information: particulars of liquid assets on one side and on the other side amount which is in crores. Now, cash is given to us as rupees 1,65,000, marketable securities rupees 75,000, bills receivables rupees 90,000, inventory rupees 1 lakh, current liquid assets rupees 4,30,000. Then we have the particulars of current liabilities. Bills payable rupees 90,000, bank overdraft rupees 80,000, outstanding expenses rupees 30,000, creditors rupees 1 lakh. Thus, total current liabilities is rupees 3 lakhs. Now, we have to calculate the absolute liquidity ratio. So, absolute liquidity ratio is equal to cash plus marketable securities divided by total current liabilities, which is equal to rupees 1,65,000 plus 75,000 divided by rupees 3 lakhs. That's a total of current liabilities, which is equal to rupees 2,40,000 divided by rupees 3 lakhs, which comes out to be 0.8. Now, we will see another ratio, which is basic defense ratio or simply defense ratio. Defense ratio is a ratio which measures the number of days a company can run on its cash expenses without any outside financial aid. It is also called defensive interval period and basic defense interval. In other words, it shows the ability of a firm to survive organically, that is, without external help. A high defense ratio is considered to be a good sign as it represents a sound financial health of a company. Now, the formula for calculating basic defense ratio is equal to current assets divided by daily operational expenses. So, we have current assets is equal to marketable securities plus cash and equivalent plus receivables. Then we have daily operational expenses, which is equal to annual operational cost minus non-cash expenses divided by 365. So, let us have a look at this illustration. The particulars of liquid assets and daily operational expenses are given as follows. You are required to calculate defense ratio. Now, particulars of liquid assets are given to us on one hand, and on the other side we have an amount. So, cash and equivalent rupees 1,05,000, marketable securities rupees 55,000, accounts receivables rupees 80,000, current liquid assets rupees 2,40,000. Then we have particulars of daily operational expenses. Annual operating cost rupees 5 lakhs, non-cash expenses rupees 70,000, daily operational expenses rupees 4,30,000 divided by 365, which is equal to 1,178. So, the basic defense ratio is equal to rupees 2,40,000 divided by 1,178, which is equal to 203. Now, we will see importance of liquidity ratios. Liquidity ratios helps in determining the ability to cover short-term obligations. It is important to investors and creditors, as it shows the ability of a firm to cover its short-term obligations. A ratio of 1 is considered to be better than a ratio of less than 1, but it is not the ideal ratio. The creditors and investors would prefer a higher liquidity ratio, such as 2 or 3. The higher the liquidity ratio is, the more likely a company is able to pay its short-term dues. A ratio of less than 1 means that a firm faces a negative working capital and may experience a liquidity crisis. The second importance is liquidity ratios helps in determining the credit worthiness. Creditors analyze liquidity ratios in deciding whether they should extend credit to a firm. They want to ensure themselves that the company will be able to pay back their amount of loan. Then the third one is liquidity ratios helps the investors in making investment decisions. Investors analyze a company with the help of liquidity ratios. It helps them to know the financial health of a company and the worth of their investment. Now, the second type of ratios we'll cover is leverage ratios. The financial position of the firm can be studied and analyzed in two perspectives, that is short-term financial position, which is also known as the short-term liquidity position, or simply the liquidity ratios that we just discussed. The long-term solvency of the firm can be studied through the leverage ratios, also known as solvency ratios. It measures the long-term financial solvency of the concern. It measures the enterprise ability to pay the interest regularly and repay the principal on maturity. The long-term sources of funds for any firm are comprising of the shareholders' funds and the long-term borrowings. In other words, the long-term resources of funds may consist of the following. The first one is the preference share capital. Then we have equity share capital. Then its accumulated profits, which is also known as retained earnings. And the last one is the long-term debts, which includes debentures plus loans. Now, the following ratios are calculated to judge the long-term financial solvency of the concern. The first one is debt equity ratio, the second one is debt total funds ratio, the third one is interest coverage ratio, then the fourth one is capital gearing ratio, and the fifth one is proprietary ratio. So, we will be discussing each of these ratios one by one. First one is debt equity ratio. Debt equity ratio, which is also known as DE ratio, is the basic and the most common measure of judging the indebtedness of the firm. This ratio measures the relative proportion of outsiders' funds and shareholders' funds invested in a particular company. This ratio is determined to ascertain the soundness of long-term financial policies of the company. The DE ratio is calculated by comparing the long-term debts with the total shareholders' funds. The formula for calculating debt equity ratio is long-term debts divided by shareholders' funds. Now, here shareholders' funds is equal to preference share capital plus equity share capital plus profit and loss account, which shows a credit balance. Then capital and revenue reserves plus reserves representing marked surplus, like reserves for contingencies minus fictitious assets. Now, long-term debts is equal to long-term loans, which includes both secured and unsecured debentures, bonds, and loans from financial institutions. A low debt equity ratio is considered as favorable from long-term creditors' point of view, as a low ratio would provide safety for the creditors, but the same ratio would be considered as unfavorable for the shareholders. It means that a low DE ratio implies a low risk to lenders and creditors of the firm, and also non-existence of trading on equity. So, neither the higher DE ratio nor the low DE ratio is desirable from the point of view of the shareholders. The balance between the proportions of debt and equity so as to take care of the interest of the lenders, the shareholders, and the firm as a whole is required. Moreover, the DE ratio of the firm is to be evaluated with reference to the industry in which the firm is operating. In some cases, the DE ratio of even 1:1 may be higher, whereas in some other cases, the DE ratio of even more than 2:1 may be acceptable. Now, we will see an illustration on this. Calculate debt equity ratio from the following: total assets rupees 3 lakhs, total debt rupees 4 lakhs, current liabilities rupees 2 lakhs. Now, the solution to this is debt equity ratio is equal to debt upon equity. Now, debt is equal to total debt minus current liabilities, which is equal to rupees 4 lakhs minus rupees 2 lakhs. That gives us rupees 2 lakhs. Now, equity is equal to total assets minus total debt, which is equal to rupees 3 lakhs minus rupees 2 lakhs, which gives us rupees 1 lakh. So, thus debt equity ratio is equal to debt divided by equity, which is equal to 2 lakhs divided by 1 lakh, which gives us 2:1. Now, the second type of ratio is debt total funds ratio. Now, debt to total funds ratio shows the long-term financial solvency of a concern. In this ratio, the outsiders' long-term liabilities are related to the total capitalization of the firm and not merely to the shareholders' funds. In other words, debt to total funds ratio shows the proportion of total assets financed by the total liabilities. The higher the total debt ratio, the more risky is the situation, because all liabilities are to be repaid sooner or later. Moreover, higher liabilities imply greater financial risk also. It is calculated as debt to total funds ratio is equal to long-term debts divided by capital employed, where capital employed is equal to long-term debt plus shareholders' funds. Now, we will see another type of ratio, that is interest coverage ratio. Now, this ratio measures a relationship between net profits before interest and taxes and interest on long-term debts. In other words, interest coverage ratio measures the ability of a concern to pay fixed interest charges as and when they become due for payment. This ratio is called debt service ratio as it measures the debt servicing capacity of a concern. This is generally expressed in number of times, and it can be calculated as interest coverage ratio is equal to net profits before interest and tax divided by periodic interest on long-term debts. Now, we will see one illustration on this. Calculate interest coverage ratio from the following. Net income after interest and tax is given to us as rupees 4,80,000. Then 10% debentures rupees 24 lakhs. Tax rate is given as 50%. Now, the solution to this question is, first of all, we have net profit before interest and tax, which is equal to net profit after interest and tax plus interest on 15% debentures plus tax, which is equal to rupees 4,80,000 plus 2,40,000 plus 4,80,000, which gives us rupees 12 lakhs. Thus, interest coverage ratio is equal to rupees 12 lakhs divided by 2,40,000, which is equal to 5 times. The next type of ratio is capital gearing ratio. Capital gearing ratio is the proportion of fixed interest bearing funds to equity shareholders' funds. Fixed interest bearing funds divided by equity shareholders' funds. Now, the fixed interest bearing funds include debentures, long-term loans and preference share capital. The equity shareholders' funds include equity share capital, reserves and surplus. Capital gearing ratio includes the degree of vulnerability of earnings available for equity shareholders. This ratio signals the firm which is operating on trading on equity. It also indicates the change in benefits accruing to equity shareholders by changing the level of fixed interest bearing funds in the organization. The next type of ratio is proprietary ratio. Proprietary ratio expresses the relationship between shareholders' net worth and total assets. Shareholders' net worth divided by total assets, that is, net worth is equal to equity share capital plus preference share capital plus reserves minus fictitious assets. Total assets is equal to fixed assets plus current assets minus fictitious assets. Reserves earmarked specifically for a particular purpose should not be included in calculation of net worth. A high proprietary ratio indicates a strong financial position of the business firm. The higher the ratio, the better it is for the firm. Now, the next we will discuss is dew point analysis. The DuPont Company of USA has introduced a system of financial analysis which has received a wider acceptance. The DuPont chart is a chart of financial ratios which analyzes the net profit margin in terms of asset turnover. The DuPont analysis is used as a tool in measuring the managerial performance by linking the net profit margin to total assets turnover. DuPont analysis is an extension of return on investment ratio, which measures the overall profitability and operational efficiency of the firm. The DuPont analysis considers the interrelationships of accounting information given in the financial statements. Comparative analysis can be done with reference to the data of the previous period or industry data or competitors' data. The DuPont chart indicates that the return on investment is ascertained as a product of net profit margin ratio and investment turnover ratio. The DuPont chart is useful in segregation and identification of factors that affect the overall performance of the company. Now, let us take a quick look at what we have done in this session. We have discussed liquidity ratios, leverage or solvency ratios and DuPont analysis. Liquidity ratios measures the liquidity of the firm and its ability to meet its short-term obligations as and when they fall due. The important liquidity ratios in measuring short-term solvency are current ratios, quick ratio, absolute liquid ratio and defense interval ratio. Current ratio shows the relationship between current assets and current liabilities. It is calculated to assess the short-term financial position of the enterprise. Quick ratio measures the short-term liquidity of the enterprise in its correct form. It shows the relationship between liquid assets and current liabilities. Then absolute liquidity ratio considers only the absolute liquidity available with the firm. Cash and bank balance and marketable securities are the examples of high liquid assets. Defense ratio is a ratio which measures the number of days a company can run on its cash expenses without any outside financial aid. Now, leverage ratios, the long-term solvency of the firm can be studied through the leverage ratios, which are also known as solvency ratios. It measures the long-term financial solvency of the concern. It measures the enterprise's ability to pay the interest regularly and repay the principal on maturity. The following ratios are calculated to judge the long-term financial solvency of the concern. The first one is debt equity ratio, then we have debt to total funds ratio, then it's an interest coverage ratio, then we have capital gearing ratio and finally the proprietary ratio. Now, debt equity ratio is the basic and the most common measure of judging the indebtedness of the firm, as discussed in the episode. This ratio measures the relative proportion of outsiders' funds and shareholders' funds invested in the company. Debt to total funds ratio shows the long-term financial solvency of a concern, and in this ratio, the outsiders' long-term liabilities are related to the total capitalization of the firm and not just merely to the shareholders' funds. In other words, debt to total funds ratio shows the proportion of total assets financed by the total liabilities. Interest coverage ratio measures the relationship between net profits before interest and taxes and interest on long-term debts. Capital gearing ratio is the proportion of fixed interest bearing funds to equity shareholders' funds. Proprietary ratio expresses the relationship between shareholders' net worth and total assets. So, that is all for today. Hope you have understood today's topic. We will see you in another episode with a new topic. Till then, take care.